Buying or selling a home is a major transaction. For most of us, the biggest transaction we ever get involved in. And buying and selling homes involves a lot of unknowns for most of us, especially the terms being used in real estate. There are many unfamiliar terms to most people, and especially if you're a first-time home buyer, these terms can seem a little bit intimidating, but also sometimes if you're a repeat home buyer, because let's face it, most of us do not buy a home on a regular basis. The average American stay in their home for 10 years these days. So what happened 10 years ago, and you might not remember all the terms and all the meanings. So I always get a lot of questions from buyers and sellers about what does this mean and how does that affect me. So I thought I would spend a little time talking about the most common terms that people ask me about. My name is Danholm, and I am a real estate broker here in Central Florida. I help a lot of buyers and sellers achieve their real estate goals all over the state of Florida. And it is a fact that knowing the terms of real estate makes you feel more comfortable in the real estate transaction. It also makes it easier for you to understand how you can achieve your goals if you know what is involved in the transaction, including the terms being used by professionals, whether it's a real estate broker, a real estate agent, or a title person, or your attorney, or whoever is talking. It's really important to know what they're talking about. And one of the biggest ones that come up is credit score, and it's not obviously directly related to real estate, but also in real estate your credit score is extremely important, especially if you're a buyer. Your credit score, simply put, is a number between 350 and 850 that shows a potential lender, including a mortgage lender, what are the chances that you are going to repay any loan they give you. The higher the score, the better the credit, and the more likely you are to repay, at least based on the number. The credit score, your credit score is calculated based on how you pay your loans, how you manage your credit. Do you always utilize your credit cards to the max, or are you being frugal and not using all your credit all the time? A lot of factors go into your credit score, and it all boils down to a calculation, a model designed to figure out whether or not you will repay a loan, or what the likelihood is of you repaying a loan. One of the biggest misconceptions from buyers relating to credit score is that you have to have a credit score in the 700s to get a mortgage. That is simply not true. At the time when I recorded this video, you can get an FHA loan with a credit score as low as 580, and you can get other loans in the mid 600s. So you don't have to have excellent credit, you have to have average or good credit to get a mortgage. The thing about your credit score, though, is the better the score, the better loan you get, and sometimes also the more loan you can get. So it is worth working on your credit score, but it's not worth giving up getting on the property ladder if you're a first-time home buyer just because your credit score is in the 600s. It's better to get an average or even a slightly not good mortgage and own property than it is to pay rent and pay off somebody else's property. Because having a mortgage and paying it on time will also improve your credit. So next time you take out a mortgage, maybe you refinance after a couple of years, you would most likely get better terms. This is something you obviously have to talk to your mortgage lender or your mortgage broker about. I'm not qualified to discuss any individual situation, but this is the general thing. The better the score, the better the loan, but don't give up just because your score is not excellent or great. Another thing that often comes up is the different terms for value of a property that we use. Generally, there are three different values on a property. There's the market value, there's the assessed value, and there's the appraised value. So when you go buy a property, you would most likely pay market value, or preferably, if you are lucky, you pay a little bit below market value. So what is this market value? Market value is the value that your home has in the open market what an average buyer will pay for your home at that given point in time, based on his or hers, based on the home's condition, not the buyer's condition, and based on location, but what the most buyers would pay for the home. That's the market value, and that should be what the home is listed at, that or close to anyways. Sometimes people want to pay over market value. We saw that last year, and there was very little inventory and many buyers. So with 50 offers on some homes, 100 offers on other homes, some buyers went ahead and say, well, I need to move, so I don't care if I'm paying market value. I'll pay sometimes several $100,000 over what the actual market value is. And that's when your market value crashes with the other term we have for value, appraised value. Because the appraised value is the objective value of the home based on the home's condition and market conditions and comparable sales in the area. In a normal market, the appraised value and the market value should be similar. So in any market it should be similar, but sometimes when the market goes crazy like it did last year, then the market value might exceed the appraised value. The appraised value is the value that your lender will use to determine how much money they'll borrow against the security in that house. And sometimes, like I said, if these two match, there can be an issue. So if the market value as determined by you, the buyer, is higher than the appraised value as determined by the independent appraiser hired by the mortgage company, it might be difficult to get the loan that you want or need to buy the property. Then there's the assessed value. The assessed value is the value determined by the local authorities, usually the county property appraiser, and is used by the county to determine the tax basis for that county, and also obviously determine how much they have to tax you on, or they can tax you on. And those three values can be very different. In an ideal world, the market value and the appraised value should be very close, and from a taxpayer's point of view, the assessed value should preferably be lower than the other two. So if the amount you're paying taxes on is lower than what you and the market perceive as the market value. So now that we have this under control, you go make an offer, and your agent asks you for earnest money or escrow money. So what is this? Well, the earnest money, or the initial escrow amount, is money that you put into escrow to show good faith to the seller. So when you write a contract, an offer on a home, you would write it for, say, $400,000, and you would say, well, I will put $3,000, $5,000, $10,000 into escrow within the next 3 days. Typically in Florida, at least, it's usually 3 days. And that money is held with an independent escrow account to show the seller that you are serious about buying a house, and it is part of your payment for the home. If you back out of the contract in time, at least here in Florida, you will get your escrow, your earnest money back. If you are unable to buy the property after all contingencies have expired, your escrow is at risk, and you might lose all or some of that money to the seller. And your escrow money is also usually part of your down payment, and the down payment is the total amount that you're putting into the property of your own money. So let's say that you're buying, again, the same $400,000 home, and you get a $350,000 mortgage. Your down payment is $50,000, and off that $50,000 you will put down the first portion as your earnest money, and then the rest you will bring to the closing table. Sometimes there will be an additional escrow in between, especially if it's a long closing. The seller might require you to put. So that's one of the downsides of recording a video while driving on your phone. The phone might ring and interrupt. So where were we? Oh yeah, down payment. The total down payment is usually between 3 and 20%. I did a video a little while back about the misconceptions of down payments, and I think we determined that first-time home buyers typically pay about 6.5% on average down payment, and repeat home buyers pay an average of 17%. And it's important to remember that both these numbers include people who paid an obscene amount of down payment, maybe 50 or 75%. And also obviously include the people who pay very little in down payment. There are options to have no down payment. There are special loan types such as VA loans that can be obtained with no down payment at all. And it's also allowed to let the seller cover your closing costs, so you can basically get into a home with absolutely or very little money out of pocket. I don't think that I would personally recommend doing that unless you have to, but that's just a personal preference. That's not in any way, shape or form financial advice. It's just my preference. I would always want personally to have a little bit of skin in the game if I'm buying a house. But if that's the only option, it's better than staying as a renter, for instance. So your down payment is your own, what you put into the house. And how much down payment you need at the end of the day is determined by your lender and the loan product you have. So some loan products require a certain amount of down payment and others require another one, and some lenders have different requirements depending on your credit score and your total financial situation. So the best bet for you to figure out how much you need to buy a home would be to talk to a mortgage broker or a mortgage lender. So I've talked a lot about mortgage rate. Mortgage rate is the interest you're paying on the money you're borrowing. It's the monthly fee, so to speak, for the lender to give you money so you can buy a house. They want to make money, so they charge interest rate on the money they're lending you. The interest rates on mortgages changes all the time. You can have different types of interest rates. You can have fixed interest rates, which means it's the same rate every month, every year for the total time the mortgage is running. You can have variable interest rate, which means that the interest rates follow the market and changes on a regular basis depending on the terms of the loan. Or you can have an ARM, which means that you have a fixed rate for a certain amount of years, and then after that it goes to a variable rate. And all of these products can be useful and can be the right depending on your situation. So again, the best thing is to talk to a mortgage lender or mortgage broker to figure out what works better for you and what the different consequences of each loan could be, long-term and short-term. One thing that's worth remembering though is that no matter what mortgage you decide on, you will almost always have an opportunity down the line to refinance. So if for instance you get a lower rate on an ARM, which is a loan with a fixed rate for the first 5 years, for instance, or 3 years or 7 years depending on the terms, and then a variable rate. If you think that the mortgage rates will go down in that period, it might be feasible for you to take the lower fixed interest rate for a limited amount of years and then go and refinance to a fixed rate for the rest of the term. But again, these are all things you should discuss with your mortgage lender. And your mortgage lender is also the person who gives you the pre-qualification letter or the pre-approval letter. And those two things are something that people, even real estate professionals, often get mixed up. So let's talk a little bit about the difference between the two. A pre-qualification letter is a letter from your mortgage broker or your mortgage lender stating that they will borrow you X amount of dollars based at this interest rate and on these other terms based on information you have provided but they have not checked. So it's a qualification based on only on the information you gave the mortgage lender. they have not verified anything, they have not checked your credit, they may have done what they call a soft credit check, but they have not checked your credit properly. They have not verified your income or your debt or anything like that. They have just based everything on what you told them. The pre-qualification letter is a really good tool for you to figure out how much home you can afford and what terms your lender will lend you money on. But it is not a guarantee that you can get a mortgage. It is an indication of what the terms would be, provided that everything you said can be verified. It doesn't mean that what you said wasn't true, but if it cannot be verified to the lender's satisfaction, it's still not considered a verification. The pre-approval letter, on the other hand, is what you should get the minute you get really, really serious about buying a home. So the pre-approval letter is a letter from your mortgage lender or your mortgage broker stating that they will most definitely lend you this amount of money at this interest rate and on these terms, provided that your situation doesn't change from the day the letter was issued and until they actually have to give you the loan. And they have verified everything you told them. They have made sure that they know that your income is good enough. They have verified your debt and everything else about your financial situation, so they know that they will give you a loan. The only thing remaining now is for you to make sure that none of this changes, and they also need to know that the home appraises. Remember, we talked about appraisals earlier in this video. So basically, and they also want to know that the home is mortgageable, that you can get free and clear title, and a few other things. But everything from the pre-approval letter actually mostly hinges on the property, not on you. As long as you don't make any major changes, don't go buy a car, don't take out a new credit card, don't pay off any credit cards, and don't close any credit cards. Don't do anything that changes your balance sheet and your income sheet, so to speak. So, but we also did a video about that previously. Another thing here in Florida that's really big for buyers is the inspection period, or the inspection contingency, or the due diligence, depending on who you talk to. This all talks about the same thing. The inspection period in the as-is contract in Florida, and I'm not giving these legal advice here, I'm just telling you where this is relevant, is a period where you as a buyer is allowed to inspect the property you're buying, but not obligated to inspect it. You can hire somebody professional to inspect it, which we all recommend you do, or you can simply inspect it yourself, or you can do like a lot of buyers do. You can use this period as a get out of jail free card, because according to the as-is contract, which is the most used contract in our brokerage, during the inspection period, the buyer can back out at any time without any explanation. You can just say, sorry, I don't want to buy this house after all. I don't want to tell you why. You can tell them why, you don't have to. I just don't feel like it anymore. So, as buyer's agents, we sometimes use it if we have an out-of-state buyer who has only seen the home on video, so they can come down and see it. They know that the house is theirs if they want it. It's sort of a hold on the house in that situation. It's obviously not what it's intended to be, but it is what it can be used for. As a listing agent, I obviously don't like when people do that, but I also recognize that this is how you can use the inspection period. So the inspection period is meant as a period where you can inspect the home, find out what's wrong with it, what you want fixed, if you want a credit for whatever you find, or simply, if need be, you can use it as a hold, where during that period you can get out anytime, no explanation needed. The inspection period, standard period according to the contract, is 15 days. In a seller's market like we've had and still have, typically that period is shorter, and when the market was really hot, some sellers didn't even want to acknowledge an inspection period. But that is what the inspection period is. you have any questions or want to know more about any of these things, or have any general real estate questions, please feel free to DM me or comment below the video, or send me a text on email. My contact information is in the description of this video. I hope you enjoyed this, and I hope it wasn't too long. Thank you so much for watching. Until next time.